Most people think the biggest financial decisions in life are obvious. Buying a house, choosing investments, starting a business, picking the right career. But there's one decision that quietly sits above all of them, and almost no one treats it with the seriousness it deserves. Marriage, not because of romance, not because of love, but because marriage is the single most powerful financial contract most people will ever sign. And yet, it's the one contract people understand the least. Today, I want to remove emotion for the conversation for a few minutes. Not because love doesn't matter. It does, but because math doesn't care how you feel. We're going to look at marriage the same way an investor would analyze a business merger. We're going to talk about risk, incentives, alignment, and outcomes. Because statistically, the person you choose to marry will matter far more to your long-term net worth than the stock market ever will. Marriage is not romantic in the eyes of the law. Here's the first thing most people never hear before walking down the aisle. In the eyes of the legal system, marriage is not a union of souls. It is a financial merger. Two economic entities combine into one. When you get married, you trigger property laws, tax, rules, debt, liability, income, sharing asset, division, rules, legal responsibility for another adult's financial behavior. None of this waits for you to figure it out later. The default settings apply immediately. Most people spend more time comparing phone plans than they do understanding the legal and financial consequences of marriage. They walk in guided by chemistry, excitement, and optimism, while completely ignoring the balance sheet. That's not romantic. That's reckless. Financial compatibility is not a nice to have. We're told that opposites attract. And maybe that works for personality. Maybe it works for hobbies. But in money, opposites don't attract, they collide. If one person views money as security, flexibility, and future freedom, and the other views money as something to be spent to enjoy the present, that is not balance. That is friction. And friction has a cost. The silent wealth killer, the spender-saver mismatch. Most financial damage in marriages doesn't come from one catastrophic event. It comes from slow erosion. Let's walk through a simple example. Imagine someone who is disciplined and intentional with money. They save $20,000 per year, invested consistently at a reasonable long-term return. That habit alone can turn into millions over a working lifetime. Now imagine that person marries someone who doesn't think they're irresponsible. They just like comfort. Nicer cars, better hotels, frequent upgrades, daily convenience, spending. No one is bad, but the household savings rate quietly drops. That $20,000 becomes $5,000. The difference doesn't look dramatic in any single year, but over decades, it's massive. This is the hidden tax of misalignment. Not because money disappears, but because compounding never gets the chance to work. And worse than the math is the psychology. One partner becomes the enforcer. The other feels controlled. Money conversations turn emotional. Eventually, the saver gives up. Not because they want to, but because the cost of resistance becomes too high. That's how long-term financial potential quietly dies. Divorce, the financial event no one stress tests. Now let's talk about the risk no one likes to acknowledge. Divorce. This isn't cynicism. It's statistics. A significant percentage of marriages end in divorce, and the odds increase for subsequent marriages. From a risk management perspective, marriage is not a guaranteed return investment. It's closer to a high-impact, low-visibility risk. And when divorce happens, the financial damage isn't just emotional, it's structural. Why divorce is so expensive, even when it's amicable. Marriage creates efficiency. Two incomes, one household, shared fixed costs. Divorce destroys that efficiency overnight. Suddenly, one household becomes two fixed cost double assets, must be divided, legal fees, enter the picture, taxes, and forced liquidation appear. Even in relatively straightforward divorces, wealth leakage is enormous. Legal fees, transaction costs, selling assets at bad times, moving expenses, higher ongoing living costs. The result? Many people walk away with far less than half of what they thought they had, and far less time left to rebuild. The loss isn't just money. It's lost momentum. The ongoing obligations most people don't price in. Then there are the long-term financial obligations. Alimony, child support. These are not punishments. They are legal mechanisms designed to account for sacrifices made during the marriage. But financially, they function like fixed liabilities. They reduce flexibility. They reduce optionality. They reduce your ability to recover. High earners can find themselves making strong incomes on paper, while living with very little freedom in reality. Not because they failed, but because the structure of the contract demands it. Money stress destroys love faster than anything else. Here's the part that often gets misunderstood. Talking about money before marriage doesn't kill romance. Avoiding money conversations does. Financial stress is one of the most consistent predictors of relationship breakdown. It creates resentment. It creates power imbalances. It turns partners into adversaries. You cannot build emotional safety on top of financial chaos. Alignment isn't cold. It's stabilizing. Financial transparency is non-negotiable. This brings us to something uncomfortable but necessary. Before marriage, there must be full financial transparency. That means income, debt, credit, history, spending patterns, financial values, risk tolerance. This isn't interrogation. It's due diligence. You would never enter a long-term business partnership without understanding the other person's financial behavior. Marriage deserves at least the same respect. Hidden debt, secret spending, avoidance around money. These are not quirks. They are warning signals. Financial infidelity is more common than people think. A significant number of people admit to hiding spending, debt, or financial behavior from their partner. This matters because in many situations, debt becomes shared. Credit scores affect both partners' assets are exposed. You're legally tied to another adult's decisions. Ignoring that reality doesn't make it go away. Why prenups are risk management, not pessimism. Prenuptial agreements have terrible branding. They're framed as unromantic, untrusting, only for the wealthy. That's wrong. A prenup is simply clarity before emotion complicates things. It allows two people, while aligned and calm, to decide what's shared, what's separate, how risk is handled, how extreme outcomes are managed. It's not planning for failure. It's planning for uncertainty. Every serious financial system uses safeguards. Marriage should be no different. When marriage becomes the ultimate wealth accelerator. Now, here's the part that often gets lost. When marriage works financially, it is one of the most powerful wealth-building structures that exists. Two aligned adults, shared values, intentional spending, long-term thinking. This creates economies of scale, stronger cash flow, redundancy in income, emotional accountability, faster compounding. A financially aligned marriage doesn't just protect wealth. It accelerates it. The stay-at-home decision is also financial. Another topic rarely discussed honestly. When one partner steps away from paid work, they're making a massive economic contribution and taking on massive personal risk. Lost earning potential, lost retirement contributions, career interruption. This is why systems like Alimony exist. But the smarter approach is proactive planning. Spousal retirement accounts, clear expectations, long-term protection for both partners. A household is a business. Both contributors matter, even if the compensation looks different. Marriage is an asset allocation decision. Here's the framework most people never use, but should. Marriage is an asset allocation choice. You are allocating time, energy, emotional capacity, future income, opportunity cost to one person. Choose accordingly. You don't allocate your entire portfolio to a volatile and proven asset. You choose stability. You choose alignment. You choose consistency. Not perfection, but reliability. What to do with this information? So what's the takeaway? If you're single, financial literacy should be a core value. not an afterthought. If you're dating, talk about money early, listen carefully to how your partner thinks about it. If you're married, build systems, create guardrails, remove unnecessary friction. Hope is not a strategy. Clarity is. Final thought. Love matters. Connection matters. But ignoring financial reality doesn't make love stronger. It makes it fragile. The right partner doesn't drain your future. They multiply it. Choose someone who compounds your life, not someone who slowly discounts it. Because heartbreak heals, but lost time and lost compounding, those don't come back. If this made you rethink how serious this decision really is, share it with someone who needs to hear it. This isn't about fear. It's about respect for your future. I'll see you in the next one.